Welcome to the midweek update with Invest with Rules. I'm Scott Bennett with the great Mike Olafson. It's September 3rd, and we have a lot to cover. We have market health, which I think is going to be pretty interesting with some of the volatility we've seen. We have our watch list, so hopefully it gives you some interesting ideas. And then we're in the thick of it in September with seasonality. We have some studies and data on seasonality that I really think you're going to find really interesting. So stick around for that. Before we jump in, Mike, how are we doing this morning on a Wednesday?
Yeah, it is kind of a little weird to have today be Wednesday. I think Monday having the market close kind of, I don't know about you, but threw me off. So yeah, here we go.
Yeah, I
Let's
would
have some
say,
fun.
yeah, absolutely. I would say it's thrown everybody off. But before we jump in, world's quickest disclosure, this is just information. It is not a direct solicitation to go buy or sell anything. Please always manage your risk, manage your stops. You know the dance. So before we jump in, our belief system. So very simply, at Invest with Rules, we have really three core beliefs. Number one, we follow the trend. Despite what we think, despite what we hear, no matter what we do, we put it through this trend roadmap system, which is we're looking at the short-term trend roughly around 30 days. We're looking at the long-term trend roughly a year. We put it through our proprietary process, which gives us these signals and trends on everything, whether it's a stock or an ETF. So, step one, follow the trend. Step two, follow big money. We care about what large funds are accumulating because they have to accumulate slowly over time. That gives us a little bit of an edge into some of their best ideas. Will they all work? Certainly not. That's why we, number three, follow risk management rules, which you'll see on display a lot here at Invest with Rules. Sometimes that's to our detriment where we own an amazing stock or ETF and it falls and we get stopped out. And sometimes it works just gloriously where we ride really great uptrends and we try to protect as much of the gains as possible. So, Mike, let's talk about the stock market score. I actually forgot to put the number at the top. How about them apples? I maybe didn't have enough coffee this morning. So, what's the stock market score? Tell me a little bit about the S&P if you don't mind.
All right. So first off, the stock market score has been it kind of faded from a 10 to a 9 and 8, and now it's back to a 9. It closed out yesterday at a 9 instead of 9 as we film this on Wednesday morning. And I think the chart kind of sums it up, or I should say the score kind of sums up the chart. You don't even have to look at the chart to know what's happening. Where here the S&P 500 is definitely showing a little bit of fade and a little bit of weakness. But in the whole scheme of things in this 1 year chart, it's really nothing to necessarily, bolt to the exit doors. Are we managing risk? Absolutely. Are we a little cautious? Absolutely. But no matter how you slice it, the uptrends, long and short term, are still aligned up. And yeah, it's kind of hard to argue with what's going on except to be cautious. What are your thoughts, Scott?
Yeah, I would say a couple things that stand out to me. So we got our short-term signal on April 24th, which is right where I'm circling. And that is when it went from a U-turn. So it's the short-term up, long-term down. And then very soon thereafter, we got the long-term trend came as well. So we've been riding with, we actually don't own the IVV. We own SPMO, we own the NASDAQ, and we've been riding this trend for a long time. And what I would simply say is that's we follow these signals, we really do. But it's really interesting. So yesterday was right over here, and you interestingly enough, I'm kind of zooming in off to the far right of the chart, and you started to kind of you gap down in the morning. You got some pretty rough news, and the market took it kind of sourly, but it ended up at the high end of the range. It's holding this area on, I'm looking at IVV, but just under 640. And as long as that continues to hold, that's great. But here's the cautionary flag is, so let's say you're filling the gap today, and let's say hypothetically you roll over. And if you roll over again, right down here, we actually got temporary, went from gas to a coast signal. So if it does officially kind of break and hold, very simply, what we do, please manage your own process, is we will take some risk off the table, we'll take some profits, and we'll lock in some gains. That's very simply what we'll do. And if the market does recover and kind of make a bigger sweep back, that's great. But in general, we would have a process to do a little bit of taking some gains off the table. And maybe a little bit of what we're seeing and why we're seeing it. This is the market health gauges. So very simply, stock market score, as you can see, as Mike said, a 9 out of 10. We're 97% invested in the market. Our beta is one, meaning we move very similar today as the market. Back in February and March, we were significantly less than one, and we really ramped it up. And then we're always watching our portfolio heat, which is very simply if all of our trailing stop losses got hit today, that would be our risk at play at the moment. So all the way to the far right is relative strength. All the way to the far left is relative weakness over the past 14 days. We're sharing with you signals and trends and something we call short-term volatility adjusted momentum, which simply means over the past roughly 30 days, it's the return divided by volatility or average true range, which gets us to a kind of a ranking system. So lo and behold, was booming today after a favorable court hearing, and XLC, which owns Google, is the strongest thing in the market right now, followed by small caps, which we own, VEU, which we own, and we own some underlying, like we own Amazon and discretionary. What's acting very poorly? I mean, you see kind of green and blues across the board, but consumer staples has been under pressure, utilities has been under pressure. Mike, what stands out to you and any comments on the S&P top 15, these mega caps, what are they saying to you?
Well, actually, let's go back if you don't mind. I want to take a step back and just talk about portfolio heat for a second. So that is ticking down as we manage risk. We cut down a little bit of risk yesterday, and our portfolio heat continues to tweak down. We're always watching that closely. So just wanted to point out how important that gauge is for us. But to answer your question about what's going on, I mean, the Google news and the action on Google today, which is part of that, Mag 7, that big chunk, a big cap chunk of the market in the S&P 500 and the Qs for that matter, it's hard to argue with what's going on. There's a lot of strength. But I guess the key question back to you, Scott, is do we still see a rotation going on as we've been seeing, or could the rotation be kind of slowing or stalling? What's your thought?
I still see it. A good example, in full disclosure, we own a position in a firm which really had booming earnings.
Yep.
And like many gap ups, they can fade. That's totally normal. But we're seeing some of the rocket ships that did really well over this past run from, we'll call it the lows of April till now. The market seems to be fading a lot of those tickers and is moving to a world where it's not every day, but you're seeing things like that. I would say like the home builders and biotechs and things like that seem to be rotating well. You're seeing flow into energy and financials are still there.
Yep.
But I've seen a lot of things move from the left to the right, and this is a really easy way to figure out what's moving and how it's working. So I hope that's helpful. But I'd say the answer is yes. I still see it, despite Google booming today. Uh,
Agree. Agree.
so again, here's our process. So when you see stocks, that's a little different. So we're looking at fund accumulation. We cut through about $1 trillion worth of data or funds that produce reports earlier. And very simply, we're looking for earnings growth and we put it through our trend roadmap. And here is our billion-dollar fund manager ranking. Here's the top 20. There's more below the surface. And very simply, thank you again, Mike. We cut clean the data and gave it to you on Labor Day, on the day off, which was totally sweet. And very simply, what we look at is a couple things. Number one, obviously the tickers, but there are 51 gas signals out of what is it, 100 and just a touch
30,
of 130.
130. Yeah.
So the number increased, it does expand and contract. Three U-turns. So remember that gas signal is short-term and long-term uptrend. There's some new overheats, and certainly they'll be at the top of the heap because this is then the strongest on a multi-momentum basis. 41 coast, 19 breaks, but you'll see at the very top, at least what I see, is Alnylam and Insmed, and you're seeing some biotech flow to the top. You're seeing some tech flow still to the top. I mean, like consumer, I would call it more of a staple, but Celsius Holdings, that energy drink. We do own a slug of Boeing. We do own a slug of a firm. And then a lot of this is on our watch list. Obviously, the top of the list works extraordinarily well after a larger pullback. Like think about like what happened to March and April. The top of the list is dynamite. And then when you're a little bit stretched in the market, we are a little bit cautious at the top. We're looking for the movement, is what we're looking for. So I've been rattling on. Mike, any thoughts on this, or we'll move to the ETFs?
I'll just give two quick comments. I think the number of gas signals versus the number of other signals, especially overheats, is actually a good sign. Where if the market is in this kind of call it this little mini, pullback or fade, if the market's going to roar higher, you want to see those gas signals because that's what we look for. That's the basis of our process is to go in on gases versus overheats, which we avoid, and of course breaks and coasts. U-turns you can't look at, of course. The other comment I'll make briefly is that it's interesting, and this kind of might tie into your comment about rotation, where normally in a rip-roaring market, you're going to see this billion-dollar fund manager stock list, which has got growthier names to it. You're going to see it outperforming the market. And the past couple of days, especially yesterday's action and now today's kind of little mini bounce, it's holding up. The list is holding up, but it's not rocking ahead of the market. So that could be another small indication of possible rotation into other sectors of the market.
Yeah, good point. And you'll see the sector, we have an ETF rank as well that we provide to you in the members area or on the live sheet. And you'll see very simply, it's clear as day, it's precious metals and its precious metal derivatives are doing extraordinarily well this year. And they're at the top of the heat. They're now on overheat, but you'll see gold miners, gold juniors, silver miners. We do own SILJ, we do own physical gold, we do own silver. So that's something that we've been on it for a long time. Very simply, you'll kind of look down, and we're always trying to clean and refine this list as best as we can, but you'll see like small cap momentum and copper miners and Ethereum. And you'll see some of the bigger movements. So on a day like yesterday, when it was a little bit of a rougher day, you saw coin data sharing BLOK, the ETF popped up pretty nicely. Defense and aerospace is still ripping. There's still life in Ethereum, specifically in uranium. So we're watching all this, and you'll see we own a lot of the stuff at the top here on the ETFs. Mike, to you.
Yeah, and a quick added point, which kind of just puts an underline under the rotation discussion and what we just said about the billion-dollar fund manager list, where this ETF list, since we've created it, it's been super helpful to me. And based on just analysis you gave us, Scott, kind of exemplifies how you look at this list, you look at the top 20, and it's dominated by non-stock growthy stuff. And what do I mean by that? The Qs are not on the list. XSMO is still here, but it's faded a wee bit. XSMO a few weeks ago, was at the top of the list in the top 5. It's faded a wee bit. And you're seeing gold miners and gold and silver, etc. So that is, I think, telling. And if we see, in fact, I don't think it's here, gut check me, but if we see energy starting or energy related ETF starting to kind of pop into let's call it the top half of the list, that's even more of a telltale sign of possible rotation.
Yeah, I mean, look at the list had XLC already at the top before the Google news kicked in. So that's kind of interesting. So
Yeah.
that's kind of
Yep.
the thesis of it. So we're
Yep.
going to move over to our watch list. So the reality is our goal for ourselves is to shrink the watch list and then to try to shrink it again. And we have kind of a now we're sharing with you the tickers, we're sharing with you if it's a stock what the billion-dollar fund manager rank is on that 2 slides ago. And members, you obviously have access to all these slides so you can dive through them if you wanted to. We're looking at that short-term volatility adjusted momentum. So who's been acting well recently? So who's kind of making that move adjusted for volatility? And then if we are going to start a new position, we are sharing with you our short-term trailing stop loss, like where we would start our risk unit. Now, obviously, please manage your own risk units and your own comfort with your stops. But this is what we're looking at. And then very simply, we're trying to shrink the list down as much as we can into what we find the most actionable. So we'll go through some tickers that are on our list. And some of this we own, we'll share with you. Some of this we're just watching. And here's one that's feels relatively new to the billion-dollar fund manager list is Freeport McMoran. So this is we're in the mining space. So obviously you can obviously see mining copper miners are very much in play. And this is really interesting. So you're on a gas signal. You don't have earnings until kind of mid-October, short-term, long-term uptrend. The short-term trend's been going for about 12 days and the long term's been going for 26 days. So you had kind of this earnings bad reaction, most likely. And now you have from FinViz at the top. This is a free charting service. They advertise like crazy. And down below, you have our trend roadmap analysis. But as long as this holds this blue line, I have a hard time figuring out why it couldn't get to 49 and make a little bit of a run. And obviously, if you are going to be lowering rates and there's going to be more home building and there's more data center building and there's more everything building, you're going to need someone to dig the copper out of the ground. So, Mike, any thoughts on Freeport McMoran, number 48?
I think you summed it up. The only thing I'll add is that magenta upper trend line. If that were to be breached, which would be obviously a good thing, it actually also coincides with at least an annual high. This is about a 1 year chart. It coincides with that. So I'm not sure, long term about FCX, but clearly that would be a good news. Not only you're breaching the trend line, but you're also breaching a 52-week high.
Yeah, good point. All right, we're going to go next. So on our list, we actually had KWEB and we had FXI, which is China Internet and or China Large Cap. And the charts look identical, so we'll just cover this just one. But it's in a short-term, long-term uptrend. You saw Alibaba have a very strong earnings reaction to the positive side. Short-term up, long-term up. Short-term's been going for about 30 days. Long-term is going for 134 days. And this is a pretty interesting part of the international space. I would have thought this would have got hit harder when the dollar went up pretty decently yesterday, but this didn't. And FinViz is telling you this is a double top, which is fine. And that actually worked. I don't know. That seems a little bit up high in the space to me from FinViz. But but in general, I think a trend line has to have three touches, or have I lost my marbles? So in general, you'll see a gap down and it's filled it. And this would not shock me if it stays in the range a bit longer until you get a little bit more clarity. But double tops can turn to triple tops. Triple tops can obviously turn to breakouts. That's totally normal. So even though it draws that, that's fine if you're a breakout trader. But very simply, as long as it holds 36, everything here looks perfectly fine and normal. And full disclosure, we have a half position on KWEB at the moment.
Yeah, I call foul on that double top. It just seems a bit. I think the AI algorithm for FinViz might have just got a little wonky there, but I think it's doing absolutely nothing wrong. I think the bottom trend line is certainly valid, and you want to see that hold. And I think that the action, I mean, it could very easily breach that March high and continue to move. It's right on the cusp. So
Yeah.
I wouldn't worry too much about that double top.
Yeah, good point. And I would say if you were to zoom out and look at a weekly or a monthly chart, I mean, KWEB has been a dog for years, and this thing could go a lot higher than you'd expect and kind
Yeah.
of climb that wall of worry in China. IBB, full disclosure, we own a position, a full position. So this is something where we've been playing this rotation for a while based on our trends and our signals. But you see how the long-term trend's been going for about 21 days, 3%, and the short-term trend's been going for about 107 days, 15%. So this really has made the move. This is your larger cap biotech plays. XBI has been on our reports on our watch list for a while as well. But this is doing nothing wrong. It is just stair-stepping higher, short-term, long-term uptrend. So far, so good. Yeah, we're pleased with the rotation trade so far with this particular ticker. I'll keep rolling unless you have anything, but
Let's go
uh,
for it.
we'll go to Welltower. So this is a growthier ticker in the real estate investment trust or REIT sector. So short-term, long-term uptrend number 49 on our report as of today. You'll see that the earnings aren't till early November, and it's just simply forming a base and consolidating after a pretty sizable run in July. So let's say interest rates do come down, let's say two more times this year. Real estate will get a little bit of a boost and a love, and some of that's already baked in, but your breakout to me looks around 155 and it's just chugging higher. So Welltower looks well positioned to continue as long as it's sustained. And I'm going to move to Shark Ninja. Full disclosure, my friend used to work there and he used to say, "Do you want anything?" And I purchased an electric vacuum and a blender, and they're dynamite. So, who would have thought? So, Shark Ninja, enough of that nonsense. Short term, long term uptrend number 69 on our list, forming kind of a flat base as it's consolidating near all time highs. This is an IPO, so we don't have long-term data. So we roll off the short term, which has been going since 6/20, and is doing nothing wrong. Up 30%. So could it very simply break up and get to the 130s and then go up and out? I guess the question, Mike, what do you think about this? And do you need a blender or an electric vacuum?
I've already got a Shark Ninja electric vacuum, which we love. It's our go-to vacuum. We have a Dyson. We have actually a third one, but the battery operated Shark Ninja is our go-to. But I tell you, Scott, there are one of the many reasons we stick to the trend roadmap and take our opinions out of it is because I think our Peter Lynch ability to kind of pick the next big winner is a little suspect, like AKA Kava of late, for example. So I don't know if hopefully people don't necessarily jump on board Shark Ninja because we like the vacuums. But back to the point about the chart action, nice action, but that large early August candle, that big old red candle, does give me a bit of pause. I don't know what happened there, not knowing the details, but I definitely want to see it kind of breach that February high and get over that upper trend line that Finviz has put in before I'm really going to be bullish about this one.
Yeah, the thing I like about so the trend road, so if you were to draw a trend line from the February highs and you kind of hit the May highs, the trend roadmap short-term signal happened right in here. So that's kind of the nice thing about it. If you just simply it will tell you the trend breakout kind of before it typically right in line or before it happens. So that's kind of the beauty of it. Full disclosure, we have a position in Boston Scientific and we've had it since 2024 and it's been a very lucrative position for us. We like to our best hold things for as long as possible, as long as our risk protocol is managed. Kava, although it's a delicious lunch or dinner, the reality is that it broke our risk, our stops, and out you go. Small
Mm-hmm.
losses is all we're willing to accept. But Boston Scientific, so we've kept these core positions. We've traded extra positions around it, like another half. We've taken it down. We've traded a half, taken it down. But that core position is up over 100% because the reality of what we really want is whatever these funds are buying, as long as the long-term trend continues, which it has been going for 688 days since 2023. That's roughly when we were starting to do this for the newsletter, and our advisory practice owns it as well. 113%. That's phenomenal. And isn't it fun to just own a very great company that is, you kind of sit on your hands because you have gains and it's done nothing wrong to you? And if I were to look at it, it's number 61 on our report. The funds still like it. It's testing that, we'll call it that 108, 107 area, and it's tested it once. There's your double top, there's your triple, there's your quadruple, here's your quintuple. And it would
Mm-hmm.
not shock me that it just breaks up and out pretty soon. And earnings are in late October. And you might, I mean, you can kind of see the volume bars when it jumps and it jumps. And it's, if there is a rotation in the seasonality of healthcare, this is where people are hiding. Mike, thoughts on Boston Scientific?
It's a really, for somebody not in BSX, it's a pretty setup. In fact, that yeah, I guess you could argue, kind of eyeballing the volume, it is shaping up to be a wee bit of a Minervini VCP type of play. I wouldn't be shocked if he's got this on his radar someplace. But yeah, it's I think your analysis is spot on, and we continue to manage our risk.
Yeah, I mean, obviously your stop could be right down here. I mean, that's pretty easy. So if you're using a short-term stop, it'll be pretty tight. So your risk is small, your upside could be quite nice.
Yeah.
GE Aerospace has been climbing for a very, very long time, but the reality is this is what happens when funds want it and it keeps going up. So short-term, long-term up, number 23. Obviously, you're not at the very beginning of the trend. I mean, the long-term trend actually started somewhere right in here, and we're not using the 200-day simple moving average, but this gold line on Finvid is. I mean, that would have been 2 days after the low, 46%. That's so much better than what the market could deliver. And this has been a gem. So obviously, GE Aerospace, if you're a momentum kind of a growth investor, this is doing absolutely nothing wrong. It's just consolidating after a massive move. And I'm going to end on PDBC. So if you're not familiar with this one, this is a ETF that trades futures that doesn't kick out a K1. And I'm not a CPA, so put that in your journal. But in general, so it primarily owns oil. It owns crude and gas, and it owns the whole basket of oils. It owns physical commodities and softs and hards like the golds and the some of the things we eat. But in general, so if one's looking for more commodity exposure without dealing with the K1 nonsense, this is something to potentially just do a little bit of homework on. And if you've seen the rotation into energy stocks, this is the physical energy which makes up most of the basket. And you just got your breakout. Now it's consolidating. So it's got the cup going. And could it kind of make another run and keep climbing if there's some steady inflation? Why not? So, Mike, any final comments as I rip through a few quick charts?
No, I think you nailed it.
Okay. After you, we're going to talk seasonality, which has been on a lot of people's minds. So our members' minds, our advisory clients' minds. We know as we enter late August into September, historically the market tends to become a clunker. Let's talk through that, the pros, the cons, and how does it all play out from kind of our research. So take it away on seasonality.
Yeah, so this up on the screen is the original member question we got back in, I want to say late June, if memory serves. And the question was this: I just got the stock market almanac and started looking through all the stats. Interestingly, it proposed a strategy of investing for 8 months from November to June and going fishing for the remaining 4 months. Results are often better and less volatile than the market. Thoughts about seasonality? Question to us. I'm personally very cautious investing in September and October based upon experiencing big downturns in those months. That's the question. Our answer at the time, back a couple of months ago, was just simply that we have a tough time necessarily wrapping our heads in statistics and data around seasonality. Yeah, it's there, it exists, but we prefer to let the market action dictate how we invest, because the trend roadmap will essentially keep us out of harm's way, major harm's way. And we showed a simple, here's the 25-year return for the S&P 500. And yes, September is down a wee bit, but if you take July through October, average them out, that 4 month period, it's 0.5% versus 1% for the remaining 8 months. So yes, the data says, yeah, you might have a little bit of an edge by, if you're a buy and holder, by holding 8 months and then selling 4 months. But the bottom line is, it's just like, to me, it's a draw, and our trend roadmap really does a trick for us. So with that said, because we're saying, hey, the trend roadmap is kind of what we need, we don't need to worry about seasonality, we decided to deeper dive in that because we're heading into September, like Scott said. So this first chart, this eye chart that we're showing, is the S&P 500 for the last 21 years. We couldn't go back 25 because we didn't have detailed month-by-month data at our fingertips. This is 21 years, buy and holding the S&P 500 as represented by SPY, the ETF. And you could see the 25 years, month by month. I'm sorry, 21 years, month by month. And the bottom green line shows you the average monthly return for each month for those 21 years. And by the way, if there are any statisticians, heavy duty data analysts in the house watching this, please be kind. I know there's a lot of holes you could kind of pop into this one, but we just wanted to do a simple analysis. So the simple analysis basically shows that the July October period that was referenced in the original question, it averages about 0.7%. November through June, about 0.9%. So yeah, there's a little bit of an edge to the 8 month period referenced over the 4 month period of July through October, but not much of one. What's interesting to note is September, which is what a lot of people seem to hone in on, definitely shows in buy and hold a bit of weakness. In fact, it is the worst month of the year for buy and hold by a bit. But I want you to notice something. We're going to talk about this in a second, but really, if you look at September, the past like 5 or 6 years have really been the biggest drag on September. So is there a bit of recency bias going on there when people look at buy and hold and seasonality? Who knows? But let's move on to the next one, Scott, which now what we do is we contrast what we just saw with simple trend following. So a commonly accepted simple trend following technique to time the market is using, for example, the 200-day simple moving average. So that's all we did. We applied the same data, 21 years, month by month, to the S&P 500 SPY and the 200-day simple moving average. You hold it when it's above, you sell it when it closes below. And here are the results. You'll see the same data, and interestingly enough, September doesn't become much of an issue. In fact, it really isn't an issue. And furthermore, that 4-month period, July to October, averages about the same as November through June. In other words, the bottom line is that the trend following, timing the market approach basically takes care of your seasonality issues for you, so you don't have to think about that and try to time it that way. Scott, before we move on and kind of recap this, any thoughts to the data here that you'd add?
My biggest thought was when you said when you're in the market in the 200-day and underneath the market, those hand gestures just made it for me. So thank you for that. That was the most fun of the analysis. So I just think let's just do the world's quickest summary and we'll wrap it up. So to me, so Mike, thanks for putting this together. So obviously there is seasonality. So it does make a really big difference if you're buying and holding. Yeah, it's September and October are weak. And we totally understand, we totally get it. Specifically the last few years, minus last year, it's been extra weak. So we understand where everyone's coming from. We know that seasonality is not a sure thing. If you were to talk to your local broker or your local advisor who does buy and hold investing, they're going to say, don't miss out on the 10 best days of the market. And they never like to say you're going to miss out on the worst 10 days of the market because that's too complex and that's not their strategy. And they're going to tell you to not deal with seasonality. And Mike, they're going to say that primarily because people are typically on the younger side and they're dollar cost averaging. But Mike, why don't you wrap us up with why they would say it, why they wouldn't say it, and then maybe the biggest takeaways.
Yeah, I think that the bottom line is that if you're a buy and hold investor, you need to kind of stick with it. And if you try to factor in seasonality, you're basically timing the market. And that's kind of our point to ponder. If you're a buy and holder and or a section of your assets are in buy and hold, but you're still thinking seasonality, well, essentially you're timing the market. So our thesis is if you're doing that and you're timing the market or thinking of it anyway, why not drop into trend following, which essentially takes care of it for you? And by the way, one thing I didn't mention when we're looking at the data, we looked at SPY. It same thing applies to the Qs. And I'm guessing if we look at small caps, et cetera, the same thing would apply in terms of the data set. So that's the real bottom line is, yes, you can time the market. If seasonality is something of concern to you, we suggest taking action in either a trend following or just DCAing.
Yeah, and obviously you kind of know where our bias is. This is what we
Yep.
really believe in. We are innately trend followers. So we have a belief system that for people that a part of one's portfolio should be in a trend following type strategy that follows trend, follows big money, follows risk management rules. Because in reality, we want, at least for me, I want to invest in a way that I don't have to experience a 30 to 50% drawdown. And the question I always think too, let's say you are more of a buy and hold investor, dollar cost averaging every 2 weeks in your paycheck is just the simplest thing to do. But wouldn't that have been really fun when you got the signal in early April to just like go in? And then that way, like you didn't have to experience that drawdown this year. You didn't have to
Yeah.
buy a falling knife, which would have totally been the case. And I'm always a little superstitious, but at the moment, year to date, we are outperforming the indexes, and we've taken substantially less risk to do so, which is obviously what our hope as a diversified trend following operation would be. We're a year where most trend following strategies are struggling. So we're very pleased with where we're at, and we care about you and your portfolios. So
You you
fire away.
did it, Scott. You said it. You said the outperform word. So we're in trouble. Buckle up.
Again, it's hard to outperform the Mag 7 when that's whatever it is. 30% of the S&P now is just a handful of stocks. And we're not in a handful of stocks. We are diversified. And because of that, by being in, let's do the rewind button. By being in some healthcare, by being in some precious metals, by being in some physical, by also owning that stuff, the Mag 7 stuff too, we're following the trend. So We are significantly more diversified. So I just want to be crystal clear that this is not us versus the S&P. That is not the agenda.
No,
Our agenda is
no.
when the world's on fire, which will happen again, just like it happened in March into April, and April finally stopped. We just don't want to be on fire with the rest of it. So can we do well diversified with trends? So I'll stop there. Again, Mike, final words as we pull through the very short week at the halfway mark.
Thanks very much for being a member. Thanks for putting up with our nonsense in this video, but hopefully you got some good stuff out of it. If the seasonality question is still in your mind, feel free to reach out to us with that or any other questions at hello@investwithrules.com. And of course, we always say this, but we really mean it. We want to help you no matter what form that is. So if you're just too darn busy and you just don't want to deal with it, and you're kind of at that point where, hey, can I get some help? Then feel free to reach out to us at hello@iwradvisors.com. And we're happy to talk to you about what we do there and how we take the great work you see here in Invest with Rules and apply it to managing some fantastic families' money.
Yeah, and we'll catch you back on Friday's video where we go through our weekly ideas of positions that we own, positions that we hold, and the decisions that we made. So we hope that helps you with your process. That's really important to see how we follow our rules. Again, enjoy your Wednesday. We look forward to catching up soon and trade well. Talk soon. Bye bye.